So gold prices are through the roof, right? And you look at a state-backed giant like Shandong Gold Mining. The question is, are you looking at a golden opportunity, or is it maybe fool's gold? Is it burdened by, heavy debt and national goals that don't quite mesh with what shareholders want? Today, we're going to dig deep, really get into the bedrock of this company to figure out what's actually going on. Welcome to the Deep Dive. This is where we take all the sources, the articles, the research, your notes, and boil it all down to the crucial nuggets of knowledge. Our mission, simple, help you understand what truly matters. And today, it's a custom deep dive into Shandong Gold Mining Co., Ltd. It trades on the Shanghai Stock Exchange, ticker 600,547.SS. Just so you know, all the data we're talking about is anchored to August 8, 2025. That's when the stock closed at 32.88 CNY.
Yeah, and what's really fascinating here, I think, is how a company's performance isn't just about, the glittering price of gold. That's part of it, sure. But it's also deeply tied to these big macro trends and its own internal stuff, how it operates, its financial health. This deep dive, it's designed to give you multiple angles. Hopefully you'll get some aha moments that go beyond just the headlines, help you really grasp the complexities of a big state-backed miner like this quickly but thoroughly.
Okay, great setup. Let's peel back those layers then. We'll start with Shandong Gold's core operations, how they make money, who's steering the ship, and crucially, the health of their balance sheet. This is part one of our deep dive. Hashtag tag chapter one, business analysis, digging for durable value. All right, so first up, how does Shandong Gold actually operate? What's their model?
Well, they're what's called vertically integrated. That basically means they control pretty much every step of the gold production process.
Every step, like from finding it to selling it.
Exactly. From the initial geological prospecting, finding the deposits, all the way through mining, processing, smelting, refining it, and then finally selling the finished gold products. Think standard gold bullions, investment bars, even alloyed gold and silver ingots.
Okay, that sounds comprehensive.
It is. And that integration is key. It lets them capture value at each stage and, potentially manage their costs more effectively than companies that only do one part. And it's not just gold either. When they refine the gold, they also get these valuable byproducts, silver, copper, zinc, lead. That diversifies their revenue a bit.
Interesting. So they're not purely a gold play.
Not purely, no. They even make some specialized mining equipment and building materials on the side. It's quite broad.
So clearly a major operation. But how big are they in the grand scheme of things, especially within China?
Oh, they're huge. Shandong Gold isn't just a player. They're a titan in China's gold market. It's a state-owned enterprise, an SOE, remember? And they're actually the second largest gold producer in China by output. Only China National Gold Group Corporation is bigger.
Second largest. Okay. What does that mean in financial terms?
Well, their scale is just immense. As of August 2025, their market cap was about 134.72 billion CNY. That translates to roughly 18.89 billion US dollars, that kind of financial heft. It lets them take on these massive projects, both domestically, in resource-rich areas like Shandong province, and internationally, think Argentina, Ghana.
Right.
So it's this combination of dominance at home and expanding reach globally that really defines their position.
So if we were to boil it down, what's their unique selling point? What makes them stand out?
I'd say their value proposition rests on three main pillars. First is just scale and operational efficiency. They really emphasize large-scale production. They talk about 100% mechanization for shoveling and transport, over 95% automation for major facilities. The goal is driving down that cost per ounce.
Makes sense. Pillar number two.
That would be the state backing and regulatory advantage. Being a key SOE gives them, support from the government, both implicit and explicit. Think easier access to capital, maybe smoother sailing through China's complex regulations. That's a huge barrier for private competitors trying to get in.
And the third pillar.
Control of strategic, high-quality assets. They own some of China's best gold deposits, particularly in the Jiaodong Peninsula. Plus, they have that significant international presence now, like the partnership with Barrick Gold at the Veladero mine in Argentina.
Okay, that paints a strong internal picture. Let's zoom out a bit. What's the wider industry looking like, the global gold scene?
Right now, it's a pretty favorable environment for gold miners, globally speaking. Gold prices have been climbing, approaching $3,400 an ounce.
Wow. Why so high?
A few things driving it. Expectations of interest rate cuts, ongoing geopolitical tensions, just general economic uncertainty around the world. Gold tends to do well in times like these. Beyond the price, though, some big trends are reshaping the industry. Digital transformation is huge: AI, data analytics, more automation. There's also a much bigger focus on ESG, environmental, social, governance factors. And we're seeing a lot of consolidation, mergers, and acquisitions as companies look to scale up.
And back in China, who are their main domestic rivals? You mentioned China National Gold is number one.
That's right. China National Gold Group Corporation, or CNGC, is the leader. Their other major domestic rival is Zijin Mining Group. They're a really interesting, globally diversified conglomerate. Just to give you an idea, Zijin produced 68 tons of gold back in 2023.
68 tons, that's serious competition.
Absolutely. The Chinese market is concentrated among these giants, and operating there means dealing with a specific regulatory setup. All mineral resources belong to the state. Companies get mining rights, usually for up to 30 years, and they pay fees and taxes. Environmental rules have gotten much stricter too, which, adds costs, but maybe favors the bigger players who can adapt.
So with all that the capital needed, the regulations, is it even possible for a new company to just start digging for gold in China?
Realistically, the barriers to entry are exceptionally high. You need massive amounts of capital, billions of dollars potentially.
Yes, sir.
Then you've got the regulatory hurdles. They're stringent, they take a long time. It can easily take over a decade from discovering gold to actually producing it. Plus, there's geological scarcity. The easy-to-find gold, it's mostly gone. Exploration is risky and expensive. And finally, you need deep technical and operational expertise. Mining isn't simple.
So it sounds like these barriers basically create a natural oligopoly. The big guys are protected.
That's a good way to put it. It really limits new competition.
Which brings us back to that state-sponsored moat for Shandong Gold. It seems like a huge advantage, right? Access to capital, help with regulations.
It is a huge advantage, no question.
Right.
Especially within China. But as you hinted, it can be a bit of a double-edged sword.
Oh, so?
Well, because decisions might not always be purely about maximizing shareholder returns, national policy objectives can play a role, and that can create problems internationally. Remember back in 2020, they tried to buy Time Resources in Canada.
Oh, right. Didn't that get blocked?
It did. Canada rejected the deal on national security grounds. It's a perfect example of how that state backing, a strength at home, became a vulnerability abroad due to geopolitical factors.
A very important point.
Yeah.
Okay, let's transition now. We've got the business landscape. Let's talk about the people in charge. #tag Chapter 2, Management Evaluation. Stewards of capital or empire builders. So the CEO, Kin Yo, been in the job over 3 years. What's the general assessment of leadership? How have they handled things?
Well, under Liu, the company has definitely seen strong revenue growth. But you have to remember, that's been heavily fueled by those high gold prices and their pretty aggressive global expansion strategy. On the surface, they talk a good game about safety. They have a 3-year action plan. They say they allocated RMB 147 million to environmental protection in 1 year.
Okay, that's what they say. But this is where it gets really interesting, right? What do independent sources say?
Yeah, this is where the picture gets complicated. Independent assessments are much less flattering. Sustainalytics, for example, gives them a severe risk rating. That puts them near the bottom compared to industry peers.
Severe risk, that sounds bad.
It's not good. The World Benchmarking Alliance also gave them a very low score, pointing out significant gaps in sustainability and human rights practices. There seems to be a real lack of transparency. Things like failing to disclose greenhouse gas emissions, not having publicly available anti-bribery policies, these are big deals now.
Any other examples?
Yeah, even a report from the LBMA, that's the London Bullion Market Association, back in 2023, noted some initial non-compliance issues. They needed a corrective action plan. So all this together suggests their ESG disclosures might be more about ticking boxes than, deeply embedding these practices into their operations.
That definitely raises some questions. So given this, how are they actually allocating capital? Where's the money going? Growth or shareholder returns?
It seems overwhelmingly focused on growth, specifically growth through big M&A deals, mergers, and acquisitions. They recently raised $500 million specifically earmarked for international acquisitions and also for refinancing debt.
Why the international focus?
Primarily because the quality of ore in their domestic mines is declining. They need access to new, high-grade assets to keep production up. This drove deals like buying that 50% stake in Barrick's Veladero mine in Argentina.
Right, you mentioned that.
And taking over Cardinal Resources to get the Namdini project in Ghana. They're spending big to expand globally.
Okay, so big spending on growth. What about giving cash back to shareholders? Are they doing things like share buybacks?
Share buybacks don't seem to be a priority at all. They do pay a dividend, which is something, The trailing yield is modest, around 0.73%.
Modest, but is it sustainable?
That's the critical question. While the dividend has grown impressively over the last 3 years from a very low base, mind you, its sustainability is really questionable. There have been times when their payout ratio actually exceeded 100%, meaning they paid out more in dividends than they earned in profit that year.
Wow. How do they manage that?
Well, when you combine that with their often negative free cash flow and really high debt levels, it tells you that dividend isn't comfortably covered by actual cash generated from the business. It could definitely be at risk if things get tough, like if gold prices fall.
So they're pouring money into growth, borrowing heavily, paying a questionable dividend.
hmm
How efficient is all this spending? Are they actually getting a good return on these massive investments?
This brings us to a really crucial metric, return on invested capital, or ROIC. How efficiently are they turning those investments into profit? For the trailing 12 months, their ROIC was just 5.16%.
5.16%. Is that good or bad?
In this context, it's deeply concerning. It's quite low. You have to
Capping.
compare that ROIC to their cost of capital, what it costs them to fund their operations through debt and equity. If their ROIC is below their cost of capital, it actually suggests that this aggressive growth strategy might be destroying long-term shareholder value, not creating it.
Destroying value.
Potentially, yes. It looks less like a strategy focused purely on profit maximization and maybe more like an empire-building strategy focused on getting bigger, possibly for strategic national reasons rather than just for shareholder returns.
Empire building versus profit maximizing. That's a key distinction. Okay, let's drill down further into the financials themselves. Hashtag Chapter 3, Financial Analysis, examining the bedrock. All right, let's get into the nitty-gritty numbers. We already touched on their huge market cap, 134.72 billion CNY, about $18.89 billion USD, clearly a large cap company. Now, revenue growth. We know it's been strong, boosted by gold prices and expansion. What are the latest figures?
But yeah, top line growth looks impressive. Trailing 12-month revenue is around 89.5 billion CNY. That's roughly $12.41 billion USD, a big jump from previous years, like $8.36 billion USD in 2023. So strong revenue growth, but profitability has been much more volatile over the last 5 years.
Well, let's talk profit margins. How much of that revenue actually makes it to the bottom line?
Okay, so TTM gross profit margin is 16.6%. Operating profit margin is 10.8%. But the key one, net profit margin, is pretty thin, just 3.6%.
Only 3.6% net. That doesn't leave much room for error, does it?
Exactly. It leaves very little cushion if costs rise unexpectedly or if gold prices take a dip. Very sensitive.
And what about free cash flow generation? You mentioned it's been an issue.
Yes, this is critical. And it's a significant weakness for Shandong Gold. If you look at Q1 2025, they actually had negative free cash flow of negative 475.32 million CNY.
Negative, so spending more cash than they brought in.
Correct. Now, for the full year 2024, their operating cash flow was positive, quite strong actually at 18.57 billion CNY. But their capital expenditures, all that spending on mines and equipment, were massive. So after CapEx, they were left with only 3.71 billion CNY in free cash flow. And this pattern, negative or very low free cash flow, it's a recurring theme. It's driven by that aggressive expansion.
And how do they fund that gap?
They have to rely on external funding, borrowing more money, or issuing more shares, which brings us to their financial stability. Now, they have been profitable in 9 out of the last 10 years. That's positive. But like we said, the size of those profits swings wildly depending on the price of gold. The biggest worry, though, is probably the debt-to-equity ratio. This measures how much debt they have compared to shareholder equity.
And what's the number?
It's alarming. It stands at 105.4%, or 1.05. That means they have more debt than equity on their balance sheet.
More debt than equity.
Yes. And it's climbed steadily. 5 years ago, it was around 31%. Now it's over 100%. That's a sign of dangerous financial leverage. Net debt to equity, which accounts for cash, is also high at 80.9%.
That sounds risky. What about their ability to pay short-term bills? Liquidity.
Another major red flag here, their current ratio, which compares current assets to current liabilities, is only 0.48.
0.48. What does that mean practically?
It means they don't have enough liquid assets like cash or things easily convertible to cash to cover their short-term obligations, debts due within a year. A healthy ratio is typically above 1, ideally closer to 2.
So less than half of what they need in the short term.
Essentially, yes. It suggests they might be funding long-term assets like mines with short-term debt. That's a risky mismatch. It creates pressure to constantly refinance or find new funding.
Okay, high debt, poor liquidity,
Uh-huh.
yet they're still paying that dividend.
Paradoxically, yes. As we mentioned, they have paid dividends in most recent years. The 3-year growth rate looks impressive on paper, 63.9%, but remember, it started from a low base. The yield is around 0.77%. But given everything else, the high debt, the poor liquidity, the often negative free cash flow, that dividend just isn't comfortably covered. It looks vulnerable, especially if gold prices drop or costs rise.
All right, a pretty concerning financial picture emerging. So how does the market value this company, given all these factors? Let's start with relative valuation. How does its price-to-earnings ratio compare?
Okay, their trailing 12-month PE ratio is sitting around 48.98.
48. How does that stack up?
It's very high. It's more than double the average PE of its direct peers, which is around 24. And it's nearly 5 times the broader industry average of about 9.8.
Wow, so the market is pricing in a lot of future earnings growth.
Exactly. Extremely high expectations are baked into that stock price, seemingly disconnected from the current thin margins and high debt.
Okay, that's relative valuation. What about trying to estimate its fundamental or intrinsic valuation, like using a discounted cash flow model?
Right. A DCF model tries to estimate a company's value based on the present value of all the free cash flow it's expected to generate in the future. It's more about fundamental worth. And interestingly, an educational DCF model we looked at actually suggests a fair value that could be significantly higher than the current share price of 32.88 CNY.
Higher. So expensive based on current numbers, but potentially undervalued based on future projections.
Precisely. And that highlights the core conflict here. It depends heavily on what you believe about the future. Key assumptions in any DCF for Shandong Gold would be future gold prices, obviously. Can they hit their ambitious production target, which is 1.725 million ounces by 2025? And what discount rate, or WACC, do you use?
WACC, weighted average cost of capital.
Yeah, basically the blended cost of their debt and equity financing. Given their operational risks, financial leverage, and geopolitical exposure, their WACC is likely relatively high, probably in the 8% to 10% range.
And if their ROIC is only 5% and their cost of capital is 8–10%?
Then they're not earning enough to cover the cost of the money they're using. That's the value destruction argument again. So the DCF outcome really hinges on optimistic assumptions about future cash flows overcoming that current inefficiency.
Okay, a lot to digest on the fundamentals. Let's move on now and connect this to the wider market view, ownership, and the big risks. This is part 2 of our deep dive. #tag chapter 4, market sentiment, the voice of this street. So we've seen the fundamentals, some concerning signs there. But how does Wall Street, or maybe more accurately, the analyst community, feel about Shandong Gold?
It's actually quite a stark contrast. The analyst consensus is overwhelmingly positive. It's a strong buy.
Strong buy. Really? How many analysts?
Out of 15 analysts covering the stock, 14 rate a strong buy, and the average 12-month price target is up at 38.4 ZNY, significantly higher than the current price.
So what's driving that bullishness, given the financial picture you just painted?
It really seems to be driven almost entirely by the macro picture, that favorable environment for gold prices. Analysts appear focused on the potential for revenue and earnings growth in a high gold price world.
But what about the debt? The low ROIC? The liquidity issues?
This is the critical disconnect. It seems like the bullish analyst sentiment is heavily discounting, or perhaps even overlooking, those significant fundamental risks. The high leverage, the inefficient capital allocation, they don't seem to be weighing heavily in the strong buy ratings.
Interesting. What about media coverage? Is it reflecting that analyst optimism?
Largely, yes. The media tone is generally positive, echoing the analyst view. Lots of focus on surging profits thanks to high gold prices, their ambitious global expansion, plans for subsidiary listings, that sort of thing. However, you do see occasional reminders pop up about the geopolitical risks, like mentions of U.S.-China trade discussions and their potential impact. So it's not entirely one-sided, but predominantly positive.
Okay. Are there any other market indicators giving us clues, like short interest?
Reliable data specifically for the Shanghai ticker can be hard to come by. But looking at their shares listed in Hong Kong, the borrow rate, basically the cost to borrow shares to short them, is around 1.50%.
Is that high or low?
It's not particularly high. It doesn't suggest an unusually large amount of bearish bets against the stock right now.
And what about the stock price itself versus its moving averages? Any technical signals?
Yeah, looking at the technicals, the stock price is currently about 6.94% below its 50-day moving average. That suggests some recent negative momentum, a bit of a short-term pullback.
Okay, short-term weakness.
But long-term?
Long-term picture looks stronger. It's still 28.14% above its 200-day moving average. That typically signals a solid underlying long-term uptrend.
So short-term dip within a longer-term rise.
Could be. That combination can sometimes signal an inflection point, maybe a pause before continuing higher, or maybe the start of a bigger correction. Hard to say just from that. All right, let's move on to who actually owns this company. #tag chapter 5. Ownership structure. Who's in control? So who holds the shares of Shandong Gold? Is it mostly institutions, insiders, or the public?
It's a mix, but with one dominant feature. You do have institutional investors involved, big names like China Securities Finance Corp, Schroeder, BlackRock, Vanguard. They hold somewhere around 20% to 22% of the shares combined. And management insiders also own a decent chunk, about 1.7 billion CNY worth of stock. That's generally seen as positive, aligning their interests with other shareholders.
Okay, but you said there's a dominant feature.
Yes. The defining characteristic here is high concentration of ownership. The parent company, Shandong Gold Group Co., Ltd., which remember is also a state-owned enterprise, holds a commanding 44.6% stake.
Nearly half the company owned by the parent SOE.
Exactly. And if you look at the top 4 shareholders together, they own over 51% of the company.
So majority control rests with just a few, primarily the state-linked parent. What does that mean for other investors?
It means the parent company, Shandong Gold Group, has the ultimate say in all major strategic decisions. Their priorities, which might include national policy objectives like resource security or supporting the Belt and Road Initiative, could potentially take precedence over maximizing financial returns for all shareholders. For minority investors, people holding the other shares, you have very little real influence on the company's direction. You're essentially along for the ride, hoping your interests align with the controlling shareholders.
Along for the ride. That sums it up well. Okay, let's consolidate all the potential upsides and downsides into a risk assessment. #tag chapter 6, risk assessment. Identifying potential pitfalls. Let's use a SWOT framework here. Strength, weaknesses, opportunities, threats. What are the core internal strengths we've identified?
The big ones are definitely that state-owned enterprise backing, the massive scale giving them economies of scale, their control of premier domestic mining assets in China, and that vertically integrated business model covering the whole production chain.
Okay, now for the internal limitations, the weaknesses. What stands out?
The weaknesses are pretty stark. Top of the list is that precarious balance sheet, the extremely high debt-to-equity ratio, over 100%, and the poor liquidity, with that current ratio below 0.5. Then there's the low return on invested capital, around 5%, suggesting inefficient use of all that investment. And finally, those poor third-party ESG ratings and the general lack of transparency we discussed.
All right, looking externally now, what opportunities could they tap into?
The biggest opportunity is clearly continued high gold prices. That's the tide lifting their boat. Further international expansion and acquisitions could secure future growth, especially if they find high-grade assets. They could also leverage technology and automation more to improve margins and potentially unlock value by listing some of their subsidiaries separately.
And the flip side of opportunities, the external threats, what are the biggest challenges looming?
Number one threat has to be a sharp decline in gold prices. That would hit their revenues and profits hard, especially with thin margins. Rising operating costs due to inflation are another major threat, squeezing those margins further. Geopolitical risk is always there, potentially blocking international deals like we saw in Canada. And increased regulatory scrutiny, particularly on environmental standards in China and globally, could significantly increase their operating costs and capital expenditures.
Let's quickly touch on those macro factors again. How does inflation specifically impact them?
Inflation hits them directly by increasing the cost of everything they need to operate: labor, fuel, explosives, equipment maintenance, you name it. It directly squeezes those already thin profit margins.
And interest rates. You mentioned a dual threat.
Right. Higher interest rates mean higher interest expense on their massive pile of debt, making it harder to service. That's the direct financial hit. But higher rates also increase the opportunity cost of holding gold. Gold doesn't pay interest, so when interest rates on bonds or savings accounts go up, gold becomes relatively less attractive to some investors, potentially putting downward pressure on its price.
Okay, and the geopolitical factors, specifically U.S.-China trade tensions. What's the tangible risk there?
It's mainly about potential tariffs. While there might be a temporary truce, the risk of the U.S. imposing tariffs potentially ranging from 10% up to 34% on Chinese-made industrial machinery and components is still there.
And Shandong Gold uses that kind of machinery.
Absolutely. Mining is incredibly capital intensive. They rely heavily on specialized equipment, haul trucks, excavators, processing plant components. Tariffs on these would directly increase their capital expenditures, the cost of buying and replacing equipment needed to maintain and develop mines. This would further strain their already weak free cash flow, making expansion projects more expensive and worsening their already shaky financial position.
Makes sense. Okay, we've covered a lot of ground. Let's try to synthesize this into a concluding outlook. Hashtag chapter 7, conclusion. So, after digging through the business, the management, the financials, the market view, and the risks, what's the optimistic take? What's the bull case for Shandong Gold?
The bull case is pretty powerful, and it's simple. Shandong Gold is a large-scale, state-backed way to play the price of gold. In a world with record-high gold prices, geopolitical uncertainty, economic worries, their revenues and earnings should grow significantly. Their aggressive international expansion gives them even more leverage to high commodity prices. It's a growth story in a hot sector, and that's clearly what the strong buy analyst consensus is focused on. You're betting on gold staying high, and this being a major beneficiary.
Okay, that's the bull case. What about the other side, the more cautious bear case perspective?
The bear case is rooted firmly in those alarming fundamentals we discussed. You've got a dangerously leveraged balance sheet debt higher than equity, critical lack of liquidity struggling to cover short-term bills, an aggressive debt-fueled expansion strategy that, so far, has generated a really meager return on invested capital, around 5%. Add to that the questionable ESG track record and the lack of transparency. Despite all these weaknesses, the stock trades at a very high PE ratio, around 48x. This suggests the market is largely ignoring these fundamental risks. The bear view is that it's a very high-risk bet, propped up by soaring gold prices that are masking deep-seated problems. If gold stumbles, the underlying issues could surface very quickly. And the valuation really captures this tension. Relative metrics like PE scream overvaluation. But, as we saw, some intrinsic models like DCF could imply undervaluation if you make optimistic assumptions about future growth and cash generation actually materializing. It highlights that core conflict in the investment thesis.
So wrapping it up, the current share price of 32.88 CNY seems to reflect a lot of market optimism about gold's future, perhaps glossing over significant company-specific risks. The leverage, the poor liquidity, the questionable efficiency of their spending.
Exactly. The investment thesis for Shandong Gold really boils down to one critical question for you, the listener, to consider. Can the powerful tailwind from a bull market in gold truly overcome the substantial underlying risks within this specific business? That gap between the current price and potentially higher intrinsic value estimates, that's the potential reward. But the company's financial fragility, the high debt, low liquidity, means there's a very thin margin of safety if gold prices reverse, or if they hit operational bumps or further geopolitical setbacks.
And as a final thought to leave you with as you process all this, in a world where state-owned enterprises like Shandong Gold play such a huge role in global markets, how much weight should you, as an investor, give to a company's strategic national ambitions versus its direct financial returns to shareholders like yourself? Something to ponder. That was a really deep dive into Shandong Gold. Hope you found it valuable. If you did, please like this video and subscribe to the Stock Analytics AI YouTube channel. Just a reminder, members who support us for €4.99 a month get priority deep dives on tickers they request. Plus, we're in the process of covering all of the S&P 500 stocks over the coming months, and members get exclusive priority access to those. And hey, if you just want a one-off deep dive on a specific stock that's caught your eye, drop us a super through, and we'll get right on it.
And the necessary disclaimer. This analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be taken as financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.